Hello and welcome to the Investing Show, powered by Timeline. I am Abraham Okusanya. Here's what we're looking at in this episode. So Robin, tell me, what have you got for us on this episode?
Well, Abraham, I think it's time we looked at active and passive investing. Is it best to use a fund manager who actively picks stocks for you, or should you simply invest in a low-cost index fund that tracks the whole market? I don't know about you, but one of the things that really annoys me is how we keep hearing about the active versus passive debate. Anyone who really knows about this subject will tell you the debate is over and there's a clear winner, and that's passive.
Indeed, and I wasn't aware that there's still a debate going on. Turns out there is. So let's get into it. Who have you been interviewing?
Well, for this episode, I interviewed Ian Tonks, Professor of Finance at the University of Bristol. He's been involved in an ongoing study of domestic active equity funds in the UK. The original research covered the 10 years from 1998 to 2008, but it's now been extended to cover the period up to 2015. The findings are consistent across the whole 17-year period the researchers looked at, and it all makes pretty grim reading for active managers. Here's the interview.
Okay, so the typical performance was around 5.5% per annum, and that was the gross performance relative to the performance of the FTSE All-Share Index over the same period, which is about 4.4%. So there appears to be some outperformance. That's not taking into account fees. And if you take into account fees, then the net performance is then less than the FTSE All-Share. Now, that's, if you like, the headline figure. But of course, what you're trying to do with this performance is trying to measure the performance relative to some benchmark, and then it depends upon what the benchmarks are that you're using. And so we have some relatively sophisticated benchmarks to try and identify this outperformance. What we find is that typically, again, about 1% of these active fund managers do systematically outperform their benchmarks, but again, only in terms of their gross returns. It's almost whatever benchmark you put up against these returns. In terms of net returns, no fund manager outperforms.
So just 1% of fund managers, you say, outperform in the long term, and even they claw back any value they add in terms of fees and charges. How hard is it to identify those managers in advance?
Suppose I've got 100 students in the room. I get them all to stand up, right? So I get 100 students to get off their backsides and they stand up. And then they get a coin out of their pocket, and I ask them to toss the coin. And then I say, everybody that's tossed the tails, they sit down. And that means about 50 people are still standing, 50 people have sat down, and I get the people who are standing to toss another coin. That's the same coin again, and again, about 50% of the people will sit down, and now we're down to 25 people standing. If I do that 6 times, I end up with 2 or 3 people still standing, right? And then I stop the game at this point because there's too much now randomness in it. But I then ask everybody in the lecture theatre to applaud those 3 people because they have this fantastic skill. They can toss 6 heads in a row, right? What an amazing skill, right? The point of that story is to say, well, of course, in any distribution, you're going to get some winners and you're going to get some losers. The question is whether the winners can keep winning, can keep outperforming. Now, the issue therefore is then when you observe this outperformance, these people that can throw 6 heads, right? The question is, are they throwing those 6 heads purely by chance, or is there some inherent skill that they've got? Right? Now, that all depends upon some benchmark that you must have in your mind about what ought to be happening. So those tests that we're doing in that paper and my research is essentially coming up with benchmarks that try and take into account the pure randomness in something to see whether people are indeed tossing coins and ending up with a result that's slightly above the chance distribution or the randomness in the distribution. But in general, tests that have looked at the persistence of fund performance typically find that those fund managers that do well over a period of time subsequently underperform, and fund managers that underperform initially subsequently outperform. So there's a kind of a reversion to the mean. So everybody comes back to the mean again, and the mean is essentially on average slight underperformance.
When I quote your research, people often say, well, that's one study. How consistent is it with other studies from around the world? Is it reinforced by other studies that are being carried out by other academics?
Yes. So it's a well-trodden path looking at the performance of mutual funds going all the way back to the 1960s, and it's not a coincidence that it's the 1960s, because that's essentially when data starts becoming available, and computers or calculators, whatever preceded computers, meant that it was possible to start looking at performance. So there's been a plethora of studies ever since the late 1960s, and essentially all of those studies are saying and showing something very similar, which is that the average active fund manager cannot outperform their benchmarks, and that's the reason that's led to an interest and an increase in passive investments.
Active managers often claim they can particularly outperform during periods of great volatility. Now, there was huge volatility around March and April of 2020 when the severity of the coronavirus crisis came to light. How did active funds perform at that time?
So there is some work from the University of Chicago. They looked at the performance of fund managers, US domestic equity fund managers, over the 10-week period from about February to April 2020, and they found that that sample typically underperformed their benchmarks by around 6%, which converts to about underperformance about 30% on an annual basis.
What about bear markets, which can, after all, be quite protracted? And an argument we often hear from active managers is that they can provide downside protection, I've heard it called. Is there any evidence of downside protection from active managers?
So it depends upon the sample that you look at, and depends upon the country. So some studies do find some evidence that fund manager performance is conditional upon the particular economic conditions. In my own work, looking back at some extensions I've done to that study that my earlier study, I have done some extensions to that, and I'm afraid I find no evidence over that period, 1998 to 2015, that there's any evidence that if you split markets into booms and slumps throughout that 17-year period, that there's any evidence of outperformance.
In spite of all this evidence that academics like yourself have come up with, that investors are probably better off in the long run investing in low-cost passive funds, why do so many people continue to invest in active funds?
There's probably a number of different behavioural factors to do with, investors' motivations. One view would be that it's just investors quite like the gamble, right? So they like the idea. In the same way that investors or individuals subscribe to the lottery or premium bonds, they like the idea that there's some chance that there could be a big payoff. So I think there's sort of that inherent perhaps gambling instinct. And then I think also the notion of active, just almost the kind of the positive term about active management, also somehow has an intuitive appeal to it, as opposed to somehow passive sounds as though you as an investor are just sitting back and waiting for things to happen. Whereas just the notion, the optimistic sound of the word active investment sounds as though It's got this positive dimension to it. And again, I think that's potentially appealing to some investors.
Can I ask, has your research changed the way that you yourself invest your own money?
So the answer is yes. I invest in a number of different passive funds. I take a strategic asset allocation view. I decide, whether I want to invest in investment overseas or in the UK, and what kind of funds do I want to invest in the UK. But then I choose, my savings are essentially in passive tracker vehicles.
So, Abraham, those are the highlights from my interview with Ian Tonks. Of course, you won't be particularly surprised, I'm sure, by the findings, but it is extraordinary, isn't it, that only around 1% of active managers beat the market in the long run on a properly cost and risk adjusted basis. Not only that, even those very few fund managers who do beat the market effectively keep any value they add for themselves in the form of fees and charges.
Surprise, surprise, yet another academic study proving what we've known for some time, that active managers underperform index funds. But the key takeaway for me, Robin, is that your odds of finding that talented manager who consistently outperforms, that needle in the haystack is zero.
Of course, Abraham, an obvious question to ask is, why do so few managers outperform? Professor Tonks thinks it's mainly down to what he calls an almost impossible balancing act. On the one hand, fund managers need to beat the market by picking the right stocks, but they also have to reduce risk, and they do that by diversifying across many stocks. And the net result of that trade-off, if you like, is usually underperformance. What's your own view?
Well, I used to think that active managers underperform because of their lack of skill. I have to say, I was wrong. In actual fact, it's the contrary. They underperform because of their skill. And this comes back to what Professor Michael Mauboussin at the Columbia Business School refers to as the paradox of skill. Investment management business is a game of skill, or it should be, because you have hundreds of thousands of very skillful people, MBAs, CFAs, PhDs, all of them playing against each other. The thing, though, is that as people become better at this activity of competing against each other, the difference between the best and the average and the best and the worst becomes much narrower. As people become more skillful, it turns out that luck becomes more important.
Yeah.
And that's precisely what happens in the world of investing, because over the short term, essentially, the results that you see is largely down to luck. But as you look over the long run, as the case of this study, luck disappears, it comes back to skill. And because the level of skill is so high, they're all competing against each other. In aggregate, it's very hard to see how one outperformed the other. The beautiful thing is that who gets the best out of this is the index investor, who just sits there and let the active managers, very competent people, compete against each other. They set the price, we just take the price that they give. And that's incredible.
And what about that other question? Why do so many people still use active funds when all the evidence suggests they shouldn't? Ian Tonks says it's partly down to people's gambling instinct and also the fact that active investing sounds better than passive. What do you make of that?
Well, there's a lot of reason, but I think it comes down to this. It's very hard to get a man or woman to to understand or agree with something when its livelihood depends on not understanding or agreeing with it. The point being that this giant industry, of active management has hundreds of thousands of people,
Yeah.
well-paid people whose job it is to market it, to promote it. There is literally billions of pounds every year of revenue, and it comes down to self-preservation. This industry has to preserve itself. I think it's essentially that. But you and I would want the pace of index investing to be higher than it is in the US. The reality is that index fund has already overtaken active funds. In the UK, index investing is grown more than doubled over the last decade, and there's still a long way to go. But and I know, Robin, you've been doing a lot of work, campaigning, educating people, and I know you want that pace to be faster. But we've already come a long way than we used to be even 5 years ago. So the message is certainly getting through. So, you've heard our opinions, but what did you make of our latest interviews? Please send us your views. From all of us here, thank you for joining us, and goodbye.